Good morning, everyone. We're going to talk about working capital and then a financing decision. But let me just give you a quick background. I'll go through some of the slide decks here. So, what we are looking at is working capital. So, that's the term, right? Um, Working capital right now is basically current assets minus current liability. So when you step back and take a look at it, current assets are your cash, accounts receivable, inventory, prepayments, and then your current liabilities would actually be accounts payable, accrued taxes, accrued expenses, or anything accrued, right? Accrued meaning that you accrue it during the year will be payable within the next 12 months. That's why you just need to do normally short term when you say accrued liabilities. So the biggest question would be, where do you get your sourcing of funds in order for you to pay your current liabilities? Because current liabilities needs to be settled or paid for using current assets. And now, when you think about working capital, which is current asset minus current liabilities, there are also things that are um, non-current assets or permanent assets. It's the same thing. That are assets that are non-current. Think about fixed assets, the property, plant, and equipment, and other types of long-term assets. Now, for example, if you are a manufacturing company, you need to establish a new warehouse, or you are a manufacturing company, you need to buy more equipment. If you're United Airlines, you need to have a right of use asset, or basically short term for a lease on some of the airplanes, new wide body or narrow body airplanes, so you can actually get to new routes and things like that. So those are not short term assets or not current assets, but are long term assets. So the question now is that, how do you finance those long term, permanent, or property, plant, and equipment? Because those are bigger amounts compared to your current assets. That's part of the working capital. So that's why we're going to be looking at what are the types of current or temporary and permanent assets or long-term assets, and then how do we finance them? So that's the question now that we need to answer. And then what are the options of financing? Do I go with a short-term debt, or do I go with a long-term debt? Long-term debt, meaning that payable within 10 years, payable within, say, 5 years or 15 years. Short-term debt with the bank might be payable in 3 years, 1 year, or 90 days, depending on the types of debt that we're going to be working with the bank on a financial institution. There is logic to it on what's the best way to optimize the company's profitability. You're not gonna go bankrupt, but at the same time, you're able to get the funding for your temporary assets and then permanent assets. There's a science to it by calculation. We're gonna go through it, and then also there are some logics that we need to make sure that we emphasize to everybody. So that's the reason why this topic is important, because we're going to go through working capital, financing decision, and then later on, maybe on week number 5, week number 6, we're going to talk about the types of liabilities or the types of debt financing that a company can get. So we're going to go deeper into that one. So I wanted to make sure that we have that background, right? Um, so working capital management is basically on looking at uh, the method of financing your current assets, and then whether you want that working capital to be financed on a long-term basis. So that's the discussion that we're going to have today, right? So the goal of the business, when you go back, is that the business wants to make money. In order for you to make money or operating profit, as we've seen before in our some of our calculation, like EBIT, right? Earnings before interest and taxes, or operating profit. In order for you to grow that, you need to make sure the company is able to deploy assets that will generate revenue in the future. That's the name of the game, right? It's a cycle. Business is basically a cycle. You start a business, you make money. Then the money that you have right now, either you keep it and reinvest to yourself, or you actually deploy more assets in order for you to generate um, more income in the future. So let's stop for a while and think about it. When I say deploy assets, what do I mean by that? If you are selling inventory, let's talk about Apple, right? If you're selling inventory, so Apple would say, I need to sell more iPhone 16. Now, and then in order for them to do that, they would either have a production line that would actually manufacture more, and then they would need to have more inventory. So either they would have capital expenditure to create more warehouses, create more manufacturing plants. Right now, they subcontract it with Foxconn, right? But like they would actually they can do their own manufacturing if they want to, or instead of doing that, they would just buy from Foxconn in bulk more inventory. So that still be deploying assets that will generate revenue in the future, right? So for example, R&D. If Apple does a lot of R&D, invest on R&D, there might be some copyright, there might be some patents. Those are assets that they deploy. And then in order for them to generate in the future revenue, because there would actually be more products with those technology to sell, right? Um, so basically, name of the game, deploy the assets for future growth. And then you could not just deploy assets using the income that you generate every year, right? So the company makes a sale, and then that sale becomes operating profit, but that might not be enough in order for you to achieve the growth strategy that you're looking at because it's only incremental, those profitability. So that's why, in order for you to fund that asset growth, you might need to take a look on ways of doing it. So that asset growth that we're talking about, let's talk about the asset. The asset can either be a self-liquidating asset or a permanent asset. Now, those self-liquidating assets, I would say, we'll just make sure that we expand the wordings, right? Because it's the same, but it's said in a different way. Self-liquidating assets are current assets, which are also equal to or similar to what we say temporary assets, right? And then permanent assets is synonymous to fixed assets or synonymous to property, plant, and equipment. Property, plant, and equipment is basically a caption in your audited financial statement. Fixed asset, it's similar to that one. Some companies or some books would call it PPE, property, plant, equipment. And then these are basically your capex. So we know what capex, right? Capex is capital expenditure. Basically, anything that you buy or you actually install, that or anything that you fix that would actually have a life more than 1 year is actually a fixed asset. And then these are basically big expenditure. Manufacturing plants, new equipment, new warehouse. These are basically a new retail site. For example, where I work with for a fuel company, if we build a new retail site or a gas station, then that's capital expenditure. I'm going to go to the next slide. So we have a graph here. I'm going to explain it to you. So here, in this one, is stage one, there's a limited or no growth of a company. You can see here, so this is actually where it starts zero, right? And then you have your x-axis, and then you have your y here. Y is in dollars, X is in the time period, basically period of time in the future, going to the right side. You have a dollar amount in between here to here. Why? Because, for example, this might be 100,000. Um, Let's say 100,000. So it means that 100,000 fixed on your fixed assets, or it did not change over a period of time. The company has no growth because you started with fixed assets worth of 100,000, but even in the future, you did not invest on fixed assets. So basically, that's limited to no growth. So what is the company banking on? So for example, this might be 100,000 level, right, at this level. So what the company is banking on is actually, like say here, is on current assets or temporary assets. So there's another 100,000, right, from here to here. And then you would see that there is actually a dip, and then it goes low, and then it goes up, and then it goes low again, right? So what we're talking about here are actually current assets. What are current assets? It can be inventory. So inventory, you start with a small amount, and then you actually peak here on this inventory, this level. And then what happened with the inventory is that later on you would sell it again. And then once you sell that inventory, then basically you deplete the inventory, and then you actually buy again inventory, and then you sell it again. So what you're focused on in this stage, in this type of company, you are only banking on the selling of current assets for profitability. That's why they were saying it's limited to no growth. You have the same fixed asset all throughout the years, and then you're just doing the ebb and tides of your seasonality of a business. Now, on a another note, on a stage two or a growth company, you can see that you are now looking at fixed asset. You started off, say, with 100,000. I'm going to show it. We'll just look at it similar, right? You started off with 100,000. But remember, fixed permanent assets is also synonymous to a fixed asset, right? So, but your permanent assets are actually growing. You're actually increasing it. And then you're not only looking at temporary assets, you're also looking at permanent assets to actually beef up the operations of the business. Now, either you acquire more inventory, you manufacture more inventory, you acquire new fixed assets in order for you to have that growth, right? But because why will there be growth? The more inventory you have, the more that you will be able to sell. The more that you're able to sell, you convert that to receivables, you convert that to cash, and then it's the cycle again. It's always the cycle of the business. You you realize cash, and then you deploy back the cash to the business. Remember when we started with week number one? Revenue is sanity, income is a sanity, but cash is king. Because revenue, you might have it, then you have operating profit, but once you have that collected as cash, then you would deploy the cash to the business, and then it goes to a cycle again. So that's why in a given period of time, companies who redeploy cash back to the business and then later on to investors through a form of dividend would actually be good because it's investing it again on itself. It's redeploying cash to the business, investing, creating sustainable growth in the future. That's basically the playbook for any organization. But that playbook that we talk about comes with a cost because you now need to say, I need to make sure that I can fund the business not only using internal funds, your own cash that you generated from net income, but through external sources. So that's what we're going to be talking about. I'm going to go change. So one thing that you would want to do is you actually match the sales and then the assets, right? What do I mean by that? So your current assets fluctuate in the short term, depending on the sales that you have. So when there's a higher demand for the business, you produce more. That's why your inventory rises. When there's a lower demand, your sales goes down. You don't want to produce more inventory. Now, that's actually matching it. At the same time, is that if the business expands, you're having more sales, you're trying to create more inventory, you may need to sustain it with fixed asset also to grow. More equipment on the production line, more warehouses, that or more even more vehicles, fixed assets, more vehicles to make sure that you are able to cope up with the sales on the higher demand for inventory, that you can distribute more on time. Imagine Amazon, at one point in time, they were thinking about having drones to deliver because it's actually maybe a faster way depending on certain geographical location compared to actually having just the big trucks, right? And then even thinking of ways of moving inventory from one location to the other as the business grows, right? Now, there is also what we need to think about is actually the cash budgeting process. We looked at it wherein, depending on the demand on our last video or last week's video, you see, I'll forecast the demand on the quantity of the wheels and casters, right? And then from there, I'm going to make a production based on an estimated desired ending inventory. And then with that, you need to forecast collection, and then you would know how much you would actually need to loan in case that you have a minimum cash balance that you're looking at. So it matching the sales, matching the assets on what needs to be done also includes a full budgeting process. I'm going to skip on the Harley Davidson. When you read the book, it talks about why Harley Davidson has a bit different of the stages of the current asset. It actually goes to a swing. Why? Because of the seasonality, right? So basically, they were saying that the sales is actually seasonal, and then it only picks up during summertime when everybody's able to drive, right? Or wintertime, you don't see people driving, but there's a seasonality. And then I'm gonna go through here. So it just talks about the collection process, similar to the calculation that we did before. Here's what I wanted to actually look at. Remember our first stage one and then stage two, like stage one, no growth, right? And it because it's only focusing on the season that it's focusing on the current asset. It's the same thing here. So Yawakuzi actually has the inventory goes up. Basically, you produce more, and then once you sell it, you actually liquidate the inventory, but you actually collect the cash because you're selling it, your inventory's out, and then you collect the cash as you go through, and then your accounts receivable goes together. Same regression, right? Or same correlation. Because as you sell the inventory, you might have it on receivable, and then your receivable increases, and then as you go down and collect it, as time goes by, you collect the receivable and you convert it into cash. So during this point in time, your inventory will be the highest. And then during this point in time, your inventory will be the lowest because of the seasonality. So think about it. I'll relate it to the business that I'm in on the fuel cycle. So we buy fuel from a refinery and then bring it to Guam. At one point in time, every 45 days, we will actually fill up our depot, our tanks with say how many um, thousands of barrels of fuel. And then at one point in time, our inventory is its highest when we receive all the fuel. But as we deplete the inventory, because we're selling it, we just need to make sure that we go to the next 45-day cycle. We're in by the next 45 days, so this is like 45 days for our business, we will get again the inventory coming into Guam. But in between, we're selling it. We're just basically disposing it for our aviation business, for our commercial business, for our fleet business, and then anybody who's buying from us, right? Retail business. So that's why at this point in time, when you think about it, when we have our inventory here, our cash is low. Why? Because we need to pay the inventory. But as we sell the inventory, our cash is going up because why? We would actually be collecting. So technically, that's that's one of the problems of the business. As you have one current asset like inventory high, you might need to pay it in case that your business is actually being asked by your vendor on a cash on delivery type. Of course, for us in the field business, we don't do cash on delivery, right? We don't pay it as we receive it. We actually ask um, our bank to fund in between certain deliveries of fuel because these are in the millions, right? So, but and then as we sell it, we realize the cash, we actually pay our bank, or sometimes we ask um, the vendor directly, can we have a 30-day terms with you or a 45-day terms with you? We're in here, let me clean it up. When we receive the inventory, remember this is 45 days right in between, 45 days before we deplete all the inventory. So this is the 45th day, right? 45th day. So on the 30th day, somewhere here, we need to pay our vendor for the fuel that was delivered here. So that's why we need to make sure that we manage cash. In at the time that we have the inventory, sell, collect. Hopefully the collection process is good because by the time that it hits 30 days, we need to pay the entire balance of what has been delivered here as inventory. So cash goes out. And then that's a reality for most businesses, right? Um, Depending on the business for their seasonality, ours in the field business, these are big bulks. Apple might be different because these are per unit of say $1,000 phone worth, but deployed in different countries. So depending on the business that you have, think about how do you manage inventory levels wherein you still have enough cash, but at the same time you look at the growth of the business wherein you invest on capital expenditures. So that's actually the question, right? The biggest question. Now, there is a financing component when you think about growth. And then, so we actually think about external sources to finance the assets. And then the matching principle is basically saying that you would like to buy current assets either to the use of your internal funds, or if you need external sources, meaning asking from the bank, you would want to pay it off quickly also. You don't want to have a long-term loan for a current asset. That's basically um, the main point. If it's a permanent asset, like a fixed asset, you would want to match it with a long-term loan because these are long-term because of the tax benefits and the nature of the long-term assets. Tax benefit for long-term assets are basically on depreciation. So long-term assets, like fixed assets, would actually have depreciations which are actually taxable or tax deductible. Let me stop there for a quick one, right? So when you buy a fixed asset or capital, so for example, that might be $3 million at one point in time. This might have an estimated useful life of say life of say 15 years on your books, right? So basically every year you're gonna be 3 million divided by 15 years, then that will be your depreciation expense. So that's your financial depreciation. I'm not gonna make it too complicated, but I just wanted to make sure that we have a stress point, an item to show you. Now, for tax purposes, there's what we call a tax depreciation. In certain cases, there might be a bonus depreciation, meaning that the depreciation that will be allowed by the IRS is higher than the 3 million divided by 15 years. And then sometimes the bonus depreciation, depending on, it can be a million percent, it can be 100% of the total capex amount with a cap. So right now, for example, you buy capex in 2024 of 3 million. In your books right now, it's 3 million divided by 15 years, so it's 200,000 every year depreciation. But for tax purposes in 2024, you can deduct directly the entire 3 million. So that's why there is a tax benefit on buying fixed assets also. Just want to make sure that we don't forget that when we consider finance. That's why when you step back a bit, those who are dealing with finance and accounting are important people in an organization. Why? Because you look at it both on a strategy point of view, on a financial reporting point of view. How do you prepare a balance sheet and income statement? What are the numbers, the key performance indicator? If we have the strategy, what will be the best method of financing it? And then you knowing the technical aspect, the practical aspect, even the tax aspect of things, you are actually a valuable or you are a valid employee within the organization. That's why those who are taking business courses, those who are taking accounting courses or finance courses are actually important in any organization. Not just the C-suite, but the C-suite or the CEO, and then the CFO relies a lot with the accounting department, finance department, accounting department, or people with business degrees, okay? Because of the knowledge that they bring forth with regard to an overall view of the business. So I want to make sure to stress the point that your course right now is actually important. Now, so it comes to this slide wherein we showed before, but now here we are now trying to match wherein you increase your assets, but you need to also finance it. And then you increase also your permanent assets. At the same time, you match it by having a long-term financing, right? So that's actually the play or one of the playbooks in finance is actually what's the best way to finance your asset needs because you need assets in order to grow the business. So two things that are core um, core knowledge, right, or truths to the business. A business would not grow unless you actually deploy more assets that you would sell that would generate income. A business is not able to pay for all the assets being deployed, whether it's actually current or non-current, whether it's temporary or permanent, whether it's actually working capital or fixed asset, all synonymous to each other, just a different term, right? Um, unless you would actually need to have some financing, and then those are being matched. A temporary or a current asset in nature are being matched or being funded using short term. And then anything that's actually fixed or permanent assets, meaning that these are long-term assets, are being financed by long-term financing, either debt and equity. Okay. And then that's what actually the slide deck is actually showing right now. So the challenge after we talked about that big background is to construct a financial plan that would categorize the current asset as temporary or categorize a current asset either temporary or permanent, and then check on the liquidation of those assets when you actually sell it, and then do a financing process. Identify the best way for you to finance the business. I'm gonna do it here. We've seen before that current assets are being matched with short-term financing. Sometimes it can be done that way, but there are times wherein these a portion of your current assets are being financed by long-term financing. So what happens with that one? Like say, for example, if we do have a here for the company that I work with, which is a fuel company, you know that we have big swings of inventory. So sometimes we have a long-term financing. We have a loan facility that we open for how many years, it's always there. In case that we need to pull in money from that loan, it's always available for us. And then those are payable on certain terms. The longer it is, the more expensive it is. But because of the nature, depending on, right? During the time that there were regional wars or the start of the wars, fuel demand is actually high. And then at the same time, there is a lot of speculation that there will be a shortage in fuel if there were wars in the Middle East, for example. That's why there's a big change on the unit price of how much we need to buy fuel. And then there was one point in time we could not just finance it using our own funds. We need to take a long-term look at it. And then now it's stable again, depending on, so it depends on the market. So every other year, or every year we take a look on what will be, or how do we see the business, and how does it actually, what is our prediction of the business on next year as we go through our budget process, and what's the best way for us to finance the need for assets. I'm going to go through a discussion on the financing decision. So basically, it's the question that we're trying to answer today. Um, the right type of financing is needed because why? Depending on whether short term or long term, some of the interest rates can be smaller or higher. Now, let's do it this way. If it's a short term financing, meaning that you need to pay the bank within 1 year, it's a relatively small amount of interest. I would say a smaller amount of interest. If you need to pay the bank over a long-term period, the interest rate will be longer. So what's the logic? If you ask the bank for a short-term financing, interest rate is small, but at the same time, you need to use the cash immediately. You need to pay the bank immediately. So you might not be liquid because you use the cash already to pay the bank, but your exposure to the interest expense, which is actually which would lower down your operating income because interest expense is an expense, right, on the income statement, will be smaller, a smaller return, but it will be low liquidity but higher return because your interest rate is not that big. If it's a long-term financing, you may be liquid because you don't pay everything at one time, because short term is one time, right? Short term would be, hey, you need to pay me within 1 year, or you need to pay me after 6 months. So if I loan 10 million to finance something, after 6 months, you need to pay all 10 million with, say, an interest rate of 10% within that 6 months period of time. So not too big of an interest expense, but your cash will be gone because you need to pay everything back by 6 months. Low liquidity, return will be higher. Why? Because interest expense is not that big. Compared to a long-term financing, on a long-term financing, you might have high liquidity. Why? Because your cash is intact. You're not paying it off in 6 months. You might need to pay it off in a spread of 10 years. So you're not using all of your cash to pay the loan, but the interest expense or the interest rate for a long-term loan will be there for 10 years, right? So you would actually have a interest rate that's actually higher, and then you would need to deduct it for how long. So your returns on your income statement might be lower, but the business is actually liquid when it comes to cash because you're not paying it off. So now that's the reason why there is a question, what is the optimal mix of short-term or long-term loans in order for you to grow the business, but you are not actually breaking the bank as they say, right? So we're going to go through the structure of the interest rate as a background there. On the interest rate, there's a yield curve. The yield curve is actually a term for interest rate on the short-term basis, relatively for short term, right? So the US government securities are normally used, which are default or basically risk-free rates. These are treasury bills that are guaranteed by or with the full backing of the United States government. That's why anything that you buy as T-bills or treasury bills, you know that the US government would actually pay it back when you actually surrender it for payment. So you have that yield curve that we actually use. So the yield curve that we use is basically within the 5 year rate of the T-bills or 10 years, because those are the yield curve that we not normally monitor, right? So whenever we in our company needs to make a loan with the bank, we'll take a look on what's the current treasury rate right now, because the bank would normally match that rate plus their own spread. So we call it a credit spread. So the bank would normally loan you money, and then they would follow a certain interbank rate. And then that interbank rate is normally similar to your yield curve on a T-bill rate, depending on what the bank uses as a benchmark. But of course, the bank would need to make money or margin to us, like the one who's borrowing. So they would call it a credit spread. Yeah. So a credit spread will be, say, a basis point or a percentage or a certain percentage that they need to add back in order for them to recover any admin costs or any, basically, that's their profit as they loan it to us. Now, there are actually some theories with regard to the yield curve, right? So we'll go through three quickly. And then the three quickly are basically on liquidity premium. And then you have the market segmentation theory and also the expectation hypothesis, right? So I'll do the liquidity premium theory. So the liquidity premium theory is that um, so in like banks would actually charge you a higher interest rate if it's actually in the future, if it's a long term. So long-term rates are higher than short-term rates. Okay, let's see why. So long-term rates should be higher than short-term rates. Why? If I am a bank and I would loan you in long term, I have a risk as a bank. My risk is that you as a company might not be paying the interest in the future. You might be in default. There's a risk of bankruptcy because there are geopolitical risks. There are risks that your business might not be doing well, a going concern rate. There's a lot of concern, right? So that's why long-term rates are actually higher compared to short-term rates. And it's the same theory wherein short-term rates are being used to fund current assets or temporary assets because of the short-term nature matching. And then long-term rates or long-term financing are being used to match anything that you need for capital expenditures or long or permanent assets. And then, so basically, when you think about it, long-term bonds. So that's actually on the point of view of the bank, right? As they sell to you. What if you as a company are the one investing? So think about the bonds. So if it's a long-term bond, the rates are longer, the rates are higher if I want to invest. It goes both ways. If I'm a company, I would like to invest on a bond that's long-term, 20 years or 10 years. It has a higher rate compared to a bond that would actually be short-term within 1 year, because my money, me as a company, my money is tied up on a long-term bond investment point of view now. And then I would only get my money back after 10 years, after 5 years. So being tied up on that one, I would expect as a company that the interest rate will be higher. Okay, so it goes both ways. Now, there's another theory called the market segmentation theory. The market segmentation theory is basically saying that, hey, you know what? The market is actually segmented into those who look at it on a short-term basis, smaller interest rate, and then those looking at it on a long-term basis with a higher interest rate. So regardless of the regardless of the rate, it's basically one will go with short term, one will go with long term. So what will happen is that it's basically independent. It does not cross over. And then it's the same reason why the liquidity premium theory is actually thinking about, hey, you know what? The longer it is, the higher the interest rate, the shorter it is, the smaller the interest rate because of the price sensitivity. So the expectation hypothesis is that I'm going to read through it. Yields on the long-term security are a function of short-term. Over a period of time, a long-term security is outstanding. So expectation hypothesis is basically averaging. So when you think about the longer it is, like 1 year to 5 year, 1 year to 3 year to 5 years, if you average those interest rate, it would almost be the same in your long-term tenures in the future. It's the expectation of how the interest actually goes through each year over year. That's why, as a result, it would actually be almost the same, depending on whether the market is on a upward or a downward curve. So, but the reason why we wanted to make sure that we go through this discussion on yield theories is that in order to solidify the understanding um, that long-term rates are actually higher compared to short-term rates because of the same the theory behind either it's because of the price sensitivity, it's because how the market responds. There's always markets between short-term and long-term, and then the expectation is actually averaging. But in most cases, it's actually the two that are predominant: liquid premium theory and market segmentation theory. I'm going to go here as a decision process. So we would have our quiz is basically the same thing for calculation. So for now, we will go through a presentation slide discussion on the key points that needs to be considered. And then I will have another video that's a calculation similar to what you have as a quiz. So you can actually see it in Excel, right, as we calculate it and as we plot it. Now here, there is actually, so Edwards Corporation has two plans, Plan A and Plan B. It has the same level of assets. It has temporary asset, it has permanent assets, all 500,000. So 500,000 is the asset, and then it needs to be funded because you need to fund it. Either you fund everything on a short-term basis, 6%, or you fund some of them, some like 150 at 6%, which is the short term, and then the remaining of the 350,000, when you add both, right? It's 500,000. So it's on the long term, 10%. You have two options as Edward Corporation. Split up the assets of the 500 that you need to fund by looking at a short-term financing at 6% for 150,000, and then the remaining 350 at 10% on long-term financing. How would it look like? And then how would it look like on your income statement when you look at the profitability? Now, so the fixed assets would actually have a 10% long-term funding, and then here's the short-term funding. So and then on top of that one, you have a fixed asset funding that you need to do long-term at 10% because that's your 10% also. Not only your current assets, but also your fixed asset. So your total funding or the total funding that you need, let me make sure it's a different color, is for your current assets, that's 500, and then your long-term financing that you need for your capex at 100, so it's 600. So both at 600, but here is a split. Your short-term financing is 150, but your long-term financing is the 350 plus the 100 that's actually on your fixed asset long-term. So when you add both, it's now 450,000. So when you add the two, it's your 600. So two different cases on the proposal, but we will see what's now going to be the impact. I wanted to highlight that for Edward Corporation on this analysis, the earnings before interest and taxes, EBIT, is the same. So we're basically just comparing, hey, what would it look like if I use plan A? What would it look like use plan B? It's the same starting point, right? But now the interest expense is different. The interest expense for that 500,000 on plan A, which is mostly or predominantly at short term, is 30,000. And then those long term, plan A, at 100,000 is 10,000. In plan B, we're saying that let's split it up, and then we would do our funding or financing is predominantly on the long term with 450 of the assets, 45, and then 150 at 6%, so it's 9,000. When you think about it, on plan A, EBIT, earnings before interest and taxes, minus the interest expense, is equals to 160 now as earnings before taxes of 160. Combined is 40,000, right? Here is actually 54,000 of taxes. So now it's actually 146. And then you have your taxes at 25%. So now you have 109,500 for plan B. And then plan A is 120,000. So how did it look like? Plan A has a higher earnings after taxes or net income compared to Plan B, which is lower. Why? Because Plan A was focused mostly on a short-term financing strategy, while Plan B is actually focused on a long-term strategy. But of course, the cash flow is different. You might have a higher return here, but your cash would actually be different because you have a lower cash on plan A. Why? Because you're paying it off immediately. You're basically you're paying off the loan immediately, not only the interest expense, but the principal. Don't forget, your loan is basically both the interest expense, here's the income statement, but your balance sheet would have a low liquidity because your cash will be lower because you need to pay it off earlier, right? Compared to plan B. So it's always about what's the impact of the financing activity on a income statement point of view, which we saw favorable for plan A, and then not so favorable for plan B, but not that big though of a difference. But the question is that what about the cash that you would have at the end of each year, right? So we always say here, capital is scarce, and then short-term financing may be difficult to find or may have very high interest rates. And then adequate financing may mean a loss or sale or financial embarrassment. Imagine if I actually have a um, a financing that I need that I was not able to secure it, then it means that I'm not able to pay for the inventory, and then it would mean that I would need to go and talk to my customers. I'm sorry, I could not deliver to you because I do not want to say because I was not able to pay for the inventory that I acquired or ordered for you, right? So that's why it might cause the loss of sale. Now, there is a calculation here. So I'm going to show you where. So where's the 10,500? 10,500 is the difference between, I'm going to go back here. The difference between, oops, this amount, the plan A, which is more favorable of an income compared to plan B. Okay, so that's actually your 10,500. So this 10,500, you're expecting a higher return, meaning a higher earnings after taxes. And then what is the probability of that happening is 80%, which means that 20% is the other probability if you have a tighter money. If you have a tighter money, what will happen is that, okay, I need to explain, right? I'm going to go back. Sorry. If I have a tighter money, this might be the way to go. Focusing on a long-term financing. Why? Because on a short-term financing, I need to pay the cash for a short period of time. But a long period of time, I would need not pay or I would not need to liquidate the entire loan at one point in time. It will be staggered. So remember this plan. I'm going to type here. No liquidity, higher returns. High liquidity. Liquidity is in terms of assets, okay? In terms of lower returns. Okay. Want to make sure we see it that way. Delete. Let's go back. So here's the difference between plan A and B. We're saying that it's 80% right now. So basically, what's happening? I need to choose plan A or plan B. I saw it. Looks kind of okay on plan A, but what's the probability that everything will fall within normal conditions? So 80%. Then the difference is 10,500. So technically, after considering the probability of conditions, then you have only 8,400 as benefit, not 10,500. Because the other one, there's a probability that you might have a tighter amount of money. And then, so the 15,000 is not a math from the calculation above or previously. It's basically just the estimate or management estimate of how much will be a lower return under Plan A with regard to a tighter money consideration. So it's basically a situational approach, and then what's the value? We're looking at 15,000, but it's only 20% chance that it's going to happen. So you always think about it when you do this scenario that it would always tie up to be 100%. So 80% in one condition plus 20% on the other condition or scenario, which is tighter money. Um, when you do this one, that's actually your estimate. And then that's about 3,000 impact, of course, negative because it's a lower return. Then you're basically, it's still beneficial for you to go with plan A by 5,400. Whether that 5,400 is significant to your company or not, you know, quantitative wise, you computed it. Qualitative wise, you need to think about it. So in accounting or finance, we always have a what we call a technical answer and a practical answer. The technical answer is it's 5,400. We're better off doing plan A. And then they would say, but what about maybe it's better for us to do plan B? Well, we considered if we have a tight money, about 20% probability. So it's not that big of an impact. But it all comes into the qualitative aspect of things also. And then how much is the risk appetite of management? Do you just wanted to go with plan A or B? Or even asking the question, is the estimate made or even the science behind of what they think is actually the probability, are those actually good? It might be 70-30, 75-25, 60-40, 50-50, 55-45, depending on, right? Um, is there enough science to it to back it out? What is management's history on doing predictive models? Are they really good at it or are they really bad at it? Or is it something that they just dived into? So those are qualitative aspects. Might be beyond a basic finance course, but those are the things that make sense when you sit down on the board and then you talk to people. Something that you always need to ask, right? The science or the calculation would always be good depending on the assumptions being taken and whether the assumptions are actually based on reasonable grounds or a bit based on things that may not happen, right? Is it sound or not sound? So those are things that you always need to consider. So that's why there's always both a technical answer and a practical answer on. And then if this will be me, I would say that, hey, you know what? here's one take, for example, one point of view might be different point of views. In the current economy, if I considered it right now, I would say we'll take plan A because it's only 20%. If I know I'm confident on what was the basis of the assumptions. But of course, if I take this approach next year, what if there's a war? What if something happened regionally? What if stronger typhoon happened that disrupts the supply chain uh, or distribution channel that I have? So it might be, hopefully, it would only go down by 5,400, so the benefit is actually zero. But if it goes down to negative territory, then basically I made a wrong decision. But those are things that are beyond sometimes the scope of any business model or any financial forecasting model. But we always take a look at it on the practical side of things. A bad number is better than no number at all, meaning that a course of action based on some science or based on some assumptions is better to work with rather than I don't have anything to begin with, right? But now that's why management has different C-suites. They need to make decisions for the business. Some are bad calls, some are good calls, but at least you are doing it with data-driven information. And of course, with data might not be always complete. Okay, so some caveats and some practicality and real life things to consider. Now, I added some items. So here's we're on tail end on this section. We'll do a calculation, and then I need to go back on break-even analysis to be sure that we talk about it. It's actually a topic from last week, but I wanted to make sure that we have a video for that to show you the degree of operating levels and the degree of financing levels. That is an important concept. But now going back here, optimal policy. So I made some calculations and whatnot. I think plan A is okay based on my initial analysis by 5,400. So, but what is now the optimal policy, right? So you need to consider items that are risk, and then it depends on the risk appetite of the business. If the company is risk averse, meaning that they shy away from risk or a bit conservative. So conservative companies will establish a long-term financing. Why? Because I will still be liquid. I will still have cash. I don't need to pay it at one time. So it will be over a period of time. That's why the interest rate, the bank would always charge you a higher rate because it's a longer period of I added some other items that I found online. I want to make sure that we actually include this one. We talk about the matching. So the company, so still based on optimal policy, some additional information that I added on the PowerPoint from our author, right? So the company should match the duration of its financing with the life of the asset. That's what we've been talking about, the graphs that we have. That's basic that we have. Wanted to highlight that one. I want to include also the cost minimization. So there's a cost of capital, right? We talked about financing right now based on debt. I'm going to loan from a bank. Later on, we're going to see that the debt financing is actually cheaper compared to equity. That's why we're focusing first on the debt. Equity is more expensive because the expectation of the shareholders is actually higher. But the expectation of the shareholder is higher, but it's based on whether they're going to declare dividends or not. But the debt is a lower interest base, meaning that it's cheaper compared to equity, but you are mandated to pay every time. We talk about it in week number one. There's also a good thing when you have loans. When you have loans or you're levered, it means that your return on equity is higher. Why? Because it's net income divided by return on equity as your net income divided by stockholders' equity. If your equity is smaller because debt is bigger, remember, asset equals liability plus equity. If you have more debt, then your equity is smaller. If you have a smaller equity, your denominator, it means that net income numerator divided by denominator, you would have a higher return on equity if you use debt as your basis of financing. The other one, there is also, don't forget to consider flexibility of certain types of financing, which we will go on week number 6. There are types of debt financing that are lines of credit. You can actually do maybe you have a cash reserve, internal funding, and whatnot. There are different types of debt financing available to us. We're going to go through it one by one. For now, we're talking about the overall concept of the optimum mix. And then also tax consideration. If you have debt, interest expense is actually deductible. If you have equity financing, dividends that you declare, those are not tax deductible. Yeah, things that needs to be considered. And I wanted to highlight, but we will go through it one more time. So this will be the last slide for this topic. A financing, okay, I'm going to use a different color. So it will be contrast. A financing plan is always being looked at for anything that you need to go to grow the business. We always say do a matching depending on the asset, right? And then a short-term financing plan, you would have a higher profit because long-term interest rates are higher, right, than short-term. But what will happen is that you would have low liquidity. Why? Because you need to pay cash right there and then after 6 months for a shorter term. But you can go in between depending on the mix. If you have a long-term financing, you have maybe a moderate to low profit because you have a higher interest expense, but you have a higher liquidity. It will go here to a higher liquidity. Why? Because you need not pay everything or use your cash to pay for the debt. There are some in between low and then high liquidity, depending on the play that you are looking at, because you can mix and match as we saw, right? Depending on the type of assets that you want to finance, you can put a portion here and there or the optimal mix. Now, I'll end the video for this topic. It's mostly theoretical, but there's some calculation involved. We will do one exercise, so make sure that we actually take a look on that exercise. And we would actually post also the break-even analysis and then one more as another exercise for this week's discussion on working capital. Thank you.